All right, Stats Canada has just released the latest Canadian CPI data for the month of January, and inflation rose 2.3% on a year-over-year basis, following a 2.4% increase in December. The gasoline price index was the largest contributor to deceleration in headline inflation, with a larger decline in January compared with December. Now, you take out gasoline, CPI rose 3% in January, matching the increase in December. For reaction and some in-depth analysis as he breaks down the numbers as they come in, Randall Bartlett is the Deputy Chief Economist at Desjardins. And Randall, thanks very much for joining us.
Oh, thanks so much for having me.
All right. First reaction, 2.3% year over year, 2.4 over compared to December. In line?
I would say even better than in line, to be honest. There was an expectation that inflation was going to remain unchanged at 2.4% in January, unchanged at the December level, and we saw it came in a tick below consensus. And so I would say when you look under the hood of this, overall, every metric that economists contribute to the consensus survey came in below expectations, and so I would say, overall, at first blush, it seems like a pretty good print for inflation and supportive of the Bank of Canada remaining on hold for the foreseeable future.
And just looking at, of course, the big thing about this over year was the temporary GST HST break. How does that weigh in? Are you surprised at where we stand with that?
I am a little surprised where we stand with that in terms of the overall contribution. I mean, we saw that in January, the price of food purchased at restaurants was up 12.3% year over year. So, this is something we anticipated. It dropped materially in January of last year. So significant decline last year, sort of a mechanical pop this year. But ultimately, it was offset by an even more material drop in gasoline prices on a year-over-year basis. And so really led to a headline print, which was fairly sanguine. And even when you remove food and energy, the impact on that sort of traditional core measure was it came in at 2.4%, down from 2.6% in December. So overall, a pretty good print with prices heading in the right direction.
All right, let's bring Martin into the conversation. Martin?
Yeah, hi, Randall. Tiff Macklem has described his job as being more difficult than usual because of the uncertainty with trade negotiations, etc. I mean, it's only 1 month's data, but do you see anything in this that would perhaps change his view?
I don't see anything that would change his view at this point in time. I think, by removing the retaliatory tariffs, by removing the consumer carbon price back at the beginning of April of last year, this really helped make the Bank of Canada's job a lot easier by keeping inflation relatively close to the bank's 2% target and letting the bank focus more on what's happening in the real economy. And so we saw those 2 cuts back in the fall, really focused on supporting the Canadian economy through the transition of this structural trade shock. And ultimately, the Bank of Canada has more room to provide support if we do get some material negative shock because inflation is relatively close to that 2% target.
Now, it's always good to see inflation going down, but are there any numbers in there that are cause for concern that may have dropped for reasons that we might not like?
Yeah, I mean, I would say overall, things are headed in the right direction. I think we've seen that, broad groups that had been contributing a great deal to inflation in the past few years, things like shelter, are really starting to, which make up a big part of the CPI basket, are continuing to move in the right direction. Whether that's ownership costs because mortgage interest costs continue to decelerate, or we're seeing that rents overall are decelerating. I would say that big contributing factor to CPI continues to move in the right direction. Overall, we are still seeing more food inflation than we're comfortable with, even when you take out the impact of that GST, HST holiday. Bank of Canada came out with a note on this recently saying a lot of this is being imported into Canada, whether it's a function of U.S. tariffs that we're sort of getting indirectly coming up on our shores here, or supply chain disruptions that are still continuing to impact because of the trade war that the United States is having. But overall, I would say we're getting a lot of broad balance within the overall inflation basket.
Martin, do you want to join?
Where do you sit, Randall, on the interest rate outlook? It seems a little bit more nuanced this year. Maybe no rate cuts, maybe a rate increase towards the end of the year. Some arguing that we're still behind the curve, or the Bank of Canada is still behind the curve. Where do you sit?
Yeah, I don't think that's necessarily an unreasonable argument to make. I think Governor Macklem has stated his position quite clearly that the Bank of Canada cannot really support the economy when there's a structural shock, like a trade shock coming from the United States. That's really the job of fiscal policy makers in negotiating trade deals, providing support to the economy that'll help reorient the economy toward greater trade diversification, infrastructure investment, that sort of thing. And so that seems to be a view that the governor has some confidence in. But ultimately, if Canada is hit with some shock, severe negative shock, potentially around CUSMA negotiation that's happening, that review into the middle part of this year, ultimately the Bank of Canada, I think, has the room with inflation where it is to provide some transitional support for the Canadian economy, really to get it through some sort of to the other side of some new economic condition and economic relationship with the United States.
And with those potential shocks, I mean, we seem to have absorbed the shocks of the initial tariffs. Would we be able to do the same? Any indicators? Would we be able to do the same with the potential of CUSMA disappearing, or a completely revised CUSMA?
We'll be coming out with a note on this next week with some scenarios around what the potential outlook could be, given different outcomes around the CUSMA joint review. But I mean, Canada's been spared much of the worst of U.S. tariffs. We've seen that we've had exemptions for CUSMA compliant goods. So really, the average effective tariff rate on exports going to the U.S. From Canada is somewhere around just shy of 4%, whereas other countries like China, even Germany, Japan, South Korea facing north of 10%, some approaching 40%. So it's really Canada's really benefited from that exemption for CUSMA compliant goods. If we don't have that going forward, it's really an unknown as to what sort of trade regime, trade deal we could have with the United States, and ultimately the sort of potential bilateral tariffs that we could be facing. And so the risks, we think, are broadly tilted to the downside. But Canada could still end up in a better trade situation than many other countries. All
right, Randall, we've got to wrap it up now. But when that report comes out next week, I'm sure we'll be talking to you then. Thanks, as always, for joining us.
Oh, my pleasure. Thanks so much for having me.
Randall Bartlett is Deputy Chief Economist at Desjardins.